Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to analyze Tesla stock. I'm going to explain why I think Tesla stock will eventually reach over 1 trillion again. More importantly, I will talk about Tesla's biggest risk and its long-term growth prospects going forward. Of course, past performance does not guarantee future results, but I still want to show you Tesla's past performance versus the S&P 500 here. Over the past 1 year, Tesla stock did recover lots. You can see that Tesla has outperformed the S&P 500 by a very large margin. Over the past 3 years, Tesla also outperformed the S&P 500, but only by a very small margin. The biggest reason is this. If you look at this here, you can see that Tesla stock has dropped a lot since its peak in March 2022. In order to fight inflation, the US Fed started raising interest rates aggressively in March 2022. This has impacted Tesla a lot because it has made EVs much more expensive to buy. High interest rates have affected the demand for EVs. At the same time, Tesla's margins have decreased a lot since the beginning of 2022. Back then, Tesla's market cap was around 1 trillion when the Fed started raising interest rates in March 2022. Now, at the time of making this video, Tesla's market cap is around 750 billion. So in this video, I'm going to explain why I think Tesla's market value will eventually reach over 1 trillion again. I will talk about Tesla's biggest risk and headwinds going forward, Tesla's long-term growth prospects, Tesla's stock valuation, and will I buy Tesla stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock reviews and investing videos a week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing. So you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Tesla's biggest risk and headwinds going forward, I want to show you one of my personal stock portfolios here. I also have other portfolios with almost the same stocks as this portfolio. This portfolio has done very well because I have invested in some of the best mega cap tech companies that have very large economic moats, great management, great products and services, increasing earnings and increasing free cash flows over time. I have Tesla in this portfolio here. Later on in this video, I will show you how to calculate Tesla's intrinsic value so you will know when it becomes undervalued, fairly valued, or overvalued. Speaking of Tesla, I think it's very important to understand Tesla's biggest risk and headwinds going forward. Tesla's first biggest headwind is this. At the time of making this video, the demand for EVs has slowed down a lot in the US and many countries around the world. The biggest reason is that interest rates have increased significantly since the beginning of 2022. This is when the US Fed started raising interest rates aggressively to fight inflation. Obviously, when interest rates are much higher, auto loan rates are much higher. Right now, it's much harder to get car loans from banks, especially when interest rates are high. Many banks are cutting down their lending. I'll give you a personal example here. When I bought my Tesla 2 years ago, my Tesla car loan was around 3%. Now a Tesla car loan is easily well over 6% or even above 7%. Many customers cannot afford to buy EVs such as Tesla Model 3 and Model Y simply because interest rates are too high. Most customers need financing to buy Tesla EVs, but high interest rates always lead to higher monthly payments. This is why the demand for EVs has slowed down a lot since the beginning of 2022. Here's the biggest problem that's affecting Tesla stock right now. To compensate for much higher interest rates, Tesla has to keep cutting prices to increase demand, so customers can still afford to buy Model 3 and Model Y, but this impacts Tesla's margins a lot. If you look at Tesla's most recent financials here, you can see that Tesla's total revenues only grew 9% year over year. This revenue growth rate is much slower than before. At the same time, Tesla's total deliveries grew 27% year over year. This growth rate is much lower than in previous quarters. This shows that Tesla's revenue growth and deliveries growth have slowed down a lot in recent quarters, mainly because of very high interest rates and lower demand for EVs. Tesla's gross margin and operating margin have decreased substantially in recent quarters since Tesla started cutting prices for Model 3, Model Y, Model S, and Model X. During this time, Tesla stock has dropped a lot. Tesla doesn't have a choice here. If Tesla keeps prices high, Tesla can still maintain very high margins, but many customers will not be able to afford Model 3 and Model Y because monthly payments are too high. Tesla will not be able to achieve 1.8 million vehicles deliveries in 2023 if Tesla doesn't lower prices. Here's another problem. Tesla used to have one of the highest operating margins in the auto industry. Now, at the time of making this video, Tesla's operating margin has dropped to 7.6% in the most recent quarter here. This is very close to the auto industry's average operating margin of 8%. The most important question is whether Tesla's margins will improve going forward once the Fed starts lowering interest rates again. In terms of free cash flow, you can see that Tesla's free cash flow did drop a lot in recent quarters because Tesla started lowering prices in order to increase the demand for EVs. Tesla does have a very strong balance sheet. For example, at the time of making this video, Tesla has around $26 billion in cash and it only has around $4.4 billion of debt. Tesla can essentially pay off all its debt and still has around $22 billion of cash left. I believe Tesla's second biggest headwind is this. Tesla will face a lot more competition, especially from Chinese EV makers going forward. According to the Wall Street Journal, China is on its way to becoming the world's largest auto exporter this year, replacing Japan. It builds roughly 2/3 of all electric vehicles globally, and the biggest Chinese EV maker, BYD, made 1.9 million vehicles last year, more than Tesla's 1.4 million. BYD is Tesla's biggest EV competitor in China. BYD sells both fully electric vehicles and plug-in hybrid vehicles. In fact, if you look at this trend here, you can see that BYD's EV sales have been growing much faster than Tesla's. BYD's EV sales have already matched Tesla's EV sales in the most recent quarter here. Looking ahead, by the end of 2023, BYD is expected to be the largest battery EV maker in China, even selling more EVs than Tesla, at least in China. Chinese customers are very sensitive to prices. BYD usually makes EVs that are much cheaper than Tesla's Model 3 and Model Y. I think this is one of the reasons that BYD will likely become the largest EV maker in China going forward. Based on what I know, there are only two major EV makers in the world that are making consistent profits. The first is Tesla and the second one is BYD. It is very capital intensive to mass manufacture EVs. In fact, most EV startups such as Rivian and Lucid lose a lot of money for every EV they make. Also, traditional car makers such as Ford and GM are losing a lot of money for every EV they sell. This is because most EV car makers have not achieved economies of scale in mass manufacturing EVs yet. It's very easy for car makers to make EVs, but it's much harder for car makers to make over 1 million electric vehicles each year and still make a profit. Based on what I know, only BYD can compete with Tesla in mass manufacturing EVs while still making profits. Here's an example. If we compare BYD's gross margin to Tesla's gross margin, you can see that BYD's gross margin has been growing consistently while Tesla's gross margin has been decreasing during the same period here. BYD's EVs are generally much cheaper than Tesla's, but BYD's gross margin is still higher than Tesla's gross margin. I think this shows that BYD has a much bigger cost advantage and larger economies of scale than Tesla when it comes to mass manufacturing EVs. For example, BYD makes its own batteries and is already one of the largest battery makers in the world. This gives BYD a huge competitive advantage compared to Tesla because the battery is the biggest cost in EVs. By mass manufacturing its own batteries, BYD can make its cost per EV much lower than Tesla's. In comparison, Tesla has to buy most of its batteries from Panasonic, LG Energy, CATL, and even BYD. Tesla is starting to make its own in-house batteries, such as the 4680 battery cell, so it will take Tesla many years to mass manufacture its own in-house batteries. Here's another potential headwind we should consider. Tesla is not unionized. This is a good thing for Tesla because union employees tend to have higher pays and therefore higher costs for the company. The United Auto Workers (UAW) will likely target Tesla more going forward. This is my own prediction. I think the UAW will not be able to unionize Tesla employees. This is because most employees working for Tesla do not want to lose their stock options or they do not want to lose their jobs. Many employees want to work for Tesla because they like Tesla's culture and because they like the growth potential of the company. You don't get the same fast-growing startup culture if you work for traditional car makers such as Ford or GM. Based on what I know, some of the Tesla employees have already become very wealthy because of Tesla stock options. This is why I think the UAW will not be able to unionize Tesla employees. I want to talk about Tesla's long-term growth prospects here. I want to explain why I think Tesla's market value will eventually reach over $1 trillion again. First, the US Fed is expected to start cutting rates starting in the middle of 2024. If you look at this CME Fed Watch tool here, you can see that there's a very high chance that the Fed will start cutting rates by May 2024. Going further, the Fed is expected to decrease rates even more by the end of 2024. Higher interest rates are affecting Tesla the most right now because higher interest rates reduce the demand for EVs. Higher car loan rates make it much harder for customers to afford Model 3, Model Y, and the upcoming Tesla Cybertruck. Once the Fed starts cutting rates in 2024, I believe Tesla will increase prices again. This is because Tesla will no longer need to lower prices to make its EVs monthly payments affordable for consumers. This means Tesla's margins will likely recover going forward, but it will be a very gradual process. Making Model 3, Model Y, Cybertruck, and the next-gen platform, such as the $25,000 EV, as affordable as possible is the most important growth driver for Tesla going forward. This is from the most recent earnings release. According to Tesla, their main goals are to reduce the cost per vehicle, increase free cash flow over time, increase the maximum delivery volumes each year, and invest in AI and other growth projects such as the Tesla Bot, Car Optimus, and the next-gen platform such as the $25,000 EV and the upcoming robotaxi service. Many investors who are very bearish on Tesla believe that Tesla's valuation is too high. They look at Tesla the same way they look at traditional car companies. They believe that Tesla should be valued the same way as traditional car makers such as Ford, GM, Volkswagen, Mercedes, and BMW. In my opinion, I think valuing Tesla like the traditional car companies doesn't make sense at all because Tesla is much more than a car company. I think we have to look at Tesla as an AI robotics company that is mass manufacturing EVs that will eventually be capable of level 4 or level 5 full autonomous driving. Tesla also makes the full self-driving FSD service, energy storage products, solar panels, supercharger networks, neural networks, a custom AI chip called the Dojo chip, the Dojo supercomputer system for AI training and computer vision training, Tesla Bot, and the next-gen platform such as the robotaxi service. If we consider all these services and technologies, especially in machine learning, neural networks, the Dojo supercomputer, AI training, and real-world application of AI and computer vision, I believe Tesla is much more than a car company. This is why I think it makes sense to value Tesla as an AI robotics company or a tech company and not as a traditional car company. Over the long run, Elon Musk believes that Tesla can reach $4 trillion market cap if Tesla can achieve all its major goals. Obviously, Elon Musk is often too optimistic in his forecast. I think it's very important not to be overhyped by Elon Musk's predictions. One of Tesla's major goals is to release the next-gen platform that will be much more affordable for mass consumers. Tesla's next-gen platform will include a $25,000 EV that is even cheaper than the Model 3. According to Reuters, Tesla is planning to build a car that will cost 25,000 euros or around 26,000 US dollars at its factory near Berlin. Sources told Reuters in September the car maker Tesla was closing in on an innovation that will allow it to die-cast nearly all of the underbody of the EV in one piece. This is a breakthrough that will speed up production and lower cost. Tesla is aiming to increase vehicle deliveries to 20 million a year by 2030. For Tesla to produce or deliver 20 million vehicles a year by 2030, Tesla will need to mass manufacture the next-gen car platform, which should be around $25,000, so most consumers can afford to buy EVs from Tesla. Just like BYD in China, Tesla will need to keep reducing the cost per vehicle in order to stay competitive. Lowering the cost per vehicle is the only way for Tesla to make profits from selling cars at around $25,000. At the time of making this video, the cost per Tesla vehicle is around $37,500. This is much lower than most other EV competitors. Tesla's biggest competitive advantage is its economies of scale or its cost advantage in mass manufacturing EVs. It is very hard to copy Tesla's vertical integration and its gigafactories around the world. Most companies make EVs lose billions every year because they have not achieved large economies of scale in mass manufacturing EVs yet. It's very easy for car manufacturers to produce several thousand EVs every year, but it's very hard to produce over 1 million EVs every year and still make consistent profits. Tesla is expected to deliver about 1.8 million electric vehicles in 2023. Based on what I know, only Tesla and BYD can mass manufacture EVs and still make consistent profits. Going forward, Tesla is planning to reduce its cost per vehicle by around 50%. Tesla is planning to accomplish this by improving its battery cells and powertrain and by improving its manufacturing processes, such as using the GigaPress die casting machine. In my opinion, I think it's extremely hard for Tesla to grow from 1.8 million vehicle deliveries a year in 2023 to as much as 20 million vehicles a year in 2030 or later. Just to compare, Toyota sold 10.5 million vehicles in 2022. Realistically, I think it will take Tesla much longer to be able to produce 20 million vehicles a year. If I have to make an educated guess, I think Tesla will eventually sell over 10 million vehicles a year, similar to Toyota. Once Tesla releases its next-gen platform and sells the $25,000 EV. Over the long term, Tesla is also aiming to produce 1 terawatt-hour each year. If you look at this here, you can see that Tesla's energy business is growing much faster than its EV business, so this will help improve Tesla's gross margin going forward. Here's another growth driver for Tesla. Tesla will start delivering the Cybertruck this year, but only a few customers will receive it. Tesla is expected to start mass producing the Cybertruck in 2024. This is my own prediction. I believe the Cybertruck will be very popular like the Model 3 and Model Y, especially in the US. Trucks are very popular in the US. For example, according to this article, there are already more than 2 million customers who have reserved the Cybertruck. Elon Musk said this about the Cybertruck. He explained that it will take longer, probably 1 year to 18 months, before the Cybertruck will produce positive cash flow for Tesla. So I just want to temper expectations for a Cybertruck. It's a great product, but financially it will take, a year to 18 months before it's a significant positive cash flow contributor. I wish there was some way for that to be different, but that's my best guess. The demand is off the charts. We have over 1 million people who have reserved the car, so it's not a demand issue, but we have to make it, and we need to make it at a price that people can afford insanely difficult things. Then he said, in conclusion, we continue to focus on ramping production while maintaining positive cash flow, and we continue to expect to have around 1.8 million vehicles deliveries as stated earlier this year. I said this earlier, many investors are concerned that Tesla's margins will stay very low going forward because of high interest rates or because of increasing competition with BYD and other major EV competitors. At the time of making this video, Tesla's full self-driving FSD service is still in beta. Once Tesla's FSD is out of beta and once it's released to the general public, I believe more and more people will pay for the FSD service on a subscription basis. I believe this will improve Tesla's gross margin going forward, but it will be a very gradual process. In terms of long-term outlook, Tesla said that they are planning to grow production as quickly as possible in alignment with the 50% CAGR target we began guiding in early 2021. In some years, we may grow faster and some we may grow slower, depending on a number of factors. For 2023, we expect to remain ahead of the long-term 50% CAGR with around 1.8 million vehicles for the year. Tesla is much bigger now than before, so it will be extremely hard for Tesla to grow its deliveries by 50% compounded each year. Elon Musk also said the same thing. He said that it's not possible for Tesla to have a compound growth rate of 50% forever. However, he expects that Tesla will still be able to grow much faster than any other car company going forward. I want to show you the consensus revenue and earnings per share forecast for Tesla here. According to Seeking Alpha, Tesla's revenue is expected to grow at around 20% each year over the next 5 years. This is much lower than the compound annual growth rate of 50% I talked about earlier. This means Tesla's vehicle delivery growth should be much slower going forward since Tesla is much bigger than before. In terms of EPS forecast, Tesla's earnings per share are expected to drop a lot in 2023. This is because of high interest rates and much lower margins that are affecting Tesla now. After that, Tesla's earnings per share are expected to grow much faster than its revenue growth. I think this assumes that Tesla will be able to improve its margins again once the Fed starts lowering interest rates. This higher earnings per share growth rate also assumes that Tesla will be able to improve its manufacturing processes and reduce the cost per vehicle going forward. I want to show you how to calculate Tesla stock's intrinsic value here, so you will know when Tesla stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Tesla's intrinsic value as its future free cash flows discounted to the present day. I use the discount rate of 11% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest headwinds and the long-term growth prospects I talked about earlier, I believe Tesla's revenue will grow at a compound annual growth rate CAGR between 17.5% and 22.5% over the next 5 years. I'm assuming Tesla's free cash flow margin will stay very low at around 6% over the next 5 years. However, if Tesla can reduce its cost per vehicle a lot and improve its gross margin, Tesla's free cash flow margin will also improve. But it's very hard to predict Tesla's margins going forward. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that Tesla's revenue will grow at a CAGR of 17.5% over the next 5 years. If we forecast Tesla's free cash flow over the next 5 years and discount the free cash flow to the present day, Tesla's intrinsic value should be around $726 billion for the entire company, or $208 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that Tesla's revenue will grow at a CAGR of 20% over the next 5 years. Then Tesla's intrinsic value should be around $803 billion for the entire company, or $230 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that Tesla's revenue will grow at a CAGR of $22.5 billion for over the next 5 years. Then Tesla's intrinsic value should be around $886 billion for the entire company, or $254 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Tesla's intrinsic value should be around $230 per share. I also used the forward price to sales valuation model here to estimate Tesla's intrinsic value, which should be around $755 billion for the entire company, or around $216 per share. If we take the average of both valuation models here, I believe Tesla's intrinsic value should be around $223 per share. Just to compare, Morningstar gave Tesla a slightly lower fair value of $210 per share. This means I believe Tesla is slightly overvalued at the time making this video. So will I buy Tesla stock? Yes, I am planning to buy more Tesla going forward once it becomes undervalued again. The Fed is expected to pivot and start cutting rates starting in 2024. I think Tesla's margins will improve going forward once the Fed starts cutting interest rates. This is my own prediction. Over the long term, I believe Tesla's market cap will reach over $1 trillion once the Fed starts lowering interest rates. I believe Tesla will eventually increase its prices for Model 3 and Model Y again, while lowering the cost per vehicle. This will improve Tesla's margins. I also believe that the Cybertruck will be a very successful product similar to the Model 3 and Model Y, but it will take time for the Cybertruck to be profitable. I showed you this portfolio earlier. These were my portfolios. I also have other portfolios that have almost the same stocks. This portfolio has done very well, and it's beating the S&P 500 by a very large margin now because I have invested in some of the best tech companies such as Apple, Google, Microsoft, Amazon, Adobe, Tesla, Nvidia, and Meta. Right now, most tech companies are overvalued, so I'm going to look into more non-tech companies that are more undervalued. I think it's important not to FOMO in this market. Eventually, the market will find something to worry about and correct again. So I want to buy the dip only when the market is very pessimistic and only invest in the best companies that are undervalued. My strategy is to invest in the best wide moat businesses that are undervalued. I like to keep buying them whenever their stocks are traded below their intrinsic business values. Then I like to buy and hold them for the long term so their intrinsic values can grow exponentially over time. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.